Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, October 29th. We got a bit of economic news releases to go over today, so we're going to jump right into it. We got the weekly jobless claims here, and last week we had 259,000. We've been kind of keeping just under 260 range. As you see, we just hit that 260 after our forecast of 265. So last week we even had a forecast 265, came in at 259. But today we came in at 260,000 people applying for unemployment. Now, here's a pretty big shocker here. GDP, I'm not real shocked, but it's lower than I would have anticipated. We had a 3.9% back in the second quarter, and the forecast is supposed to come down a little bit to about 1.8 range for the third quarter. And this is the first version here, where November will get the second, and then the final come in December. But came in even lower at 1.5% for our basically our gross domestic product. Initially, we've been trying to think of that we're going to be between 2.5%, but that's a very disappointing, especially after first quarter very slow when we came in at a final of 0.2%, and then we had a final of 3.9, and for a second now we're at 1.5. Obviously, not very good year. The economy doesn't seem to be going as rapidly or as stable as maybe the Fed may be expecting, which may come to light, which we'll touch on here in a minute here. We also got pending home sales, which is not showing good numbers either. We had back in August 1.4% drop of 1.4%, and then it dropped again another 2.3% in the month of September. So not overall good numbers. The stock market now is changing their outlook on things, where before if it was bad news, it was good news to them. Now it's basically if it's good news, it's good news, bad news is bad news. So now that, as you can see, the stock market is down currently right now as a result of the bad data basically that's out there. But also the FOMC had their statement released yesterday, and basically it did state on there that they increased the likelihood of a possible rate hike in December, because it looked like it was pretty strong wording, more hawkish than dovish in terms of a possible rate hike for December. So it was down to about 36%. Now they increased to about 43% of a likelihood of possible rate hike in the month of December. Now they did say they're going to look at global aspects of things, but they think that the U.S. economy may be able to keep building without the global influence. So we'll have to kind of wait and see, obviously, for December. So December's going to be a big month for a lot of shakiness, a lot of volatility coming up. And while the market is down, so is the bond market. So as you can see, we saw yesterday we had a pricing for the worst, so pricing got worse yesterday, and then today we're down to about another 25 basis points. Now you could note with that blue line, that was our 200-day moving average, and that was going to provide a good strong floor of support. But right now, so far, we broke below that. So my feeling long term that this could be short term. Now, if the stock market's down and the bond market is down, so where's the money going to? It's actually going into the 10-year Treasury. Later today, we got the Fed also having an auction around 1 o'clock Pacific or 1 o'clock Eastern time. So we may see some improvement in the bond market, assuming that the Fed buys enough of the mortgage-backed securities to help offset today's losses. So that might be able to help us out a little bit later today. But of course, it could go the opposite direction as well. That's something to keep on later this morning here. All right, folks, not good news on the interest rates, of course, even on the stock market, even though the stock market did rally a little bit yesterday and it showed a little bit of improvement. But today they're down with the bad data that we received today. All right, folks, have a wonderful day. Thanks so much for watching. We'll catch you guys tomorrow. Thanks so much for watching. Bye-bye.